Hi everyone, that's me, and I speak GAAP. But now I'm learning about IFRS. That's right, the world's financial language. International Financial Reporting Standards. My name is Mervat Saleh, and today I'll guide you through how the world speaks the same financial language. Even though the topic sounds dry, I promise to make it fun, visual, and understandable. Let's begin our IFRS journey. Why the world needs IFRS. Before every country used its own accounting rules, imagine comparing a company in Japan to maybe one in France. Well, it's like comparing sushi and croissants, right? With global investing, international mergers, and multinational operations, the world needs one consistent financial language. IFRS was created to make a financial statements comparable, transparent, and investor-friendly worldwide. So, who creates IFRS? Well, IFRS standards come from the International Accounting Standard Boards, aka the IASB. They are an independent organization based in London, responsible for creating and updating global accounting rules. Think of them as the grammar policy, or grammar police. Well, for the world's financial language at least. When the IASB issues a new standard, everybody pays attention, because it can change how trillions of dollars are reported. So, which countries use IFRS? Well, today, more than 140 countries either require or permit IFRS. This includes the entire European Union, Australia, Canada, most of Asia, and many emerging markets. The United States is a major outlier. Believe it or not, the U.S. does not use IFRS. We use GAAP. But even U.S. companies with global operations often prepare IFRS reports. This widespread adoption is proof of IFRS becoming a global financial language. So, what is the IFRS made of? Well, the IFRS it's not a single rule book. It's made of multiple parts. So the IFRS standards, which are the newer ones, the IAS standards, which are the older ones but are still being used. Then there's areas of interpretation that will clarify tricky areas. And also the Conceptual Framework, which is basically the backbone of the IFRS thinking. Together, these parts guide how companies measure, record, and report their finances. Now that we've talked about why IFRS exists, let's look at the actual standards themselves. IFRS includes 17 modern standards created by the International Accounting Standards Board. These are the new generation standards, the ones that replace older rules and brought more consistency across the globe. Some key examples include IFRS 9, which governs financial instruments, IFRS 15 for revenue recognition, IFRS 16 for leases, and IFRS 17 for insurance contracts. These standards are designed to be principle-based, meaning they focus on concept and judgment rather than hundreds of detailed rules. Each IFRS standards address a major area of financial reporting, such as consolidation, fair value measurement, segments, and disclosures. Together, they form the backbone for global financial communications. These are the standards that keep financial statements from Tokyo to Toronto speaking the same language. Before the IASB existed, the older standards setting body issue was called the IAS, International Accounting Standards. Even though they are older, 29 IAS standards are still fully active today. They cover some of the most fundamental areas of accounting, such as inventory, cash flows, property, plants and equipment, income taxes, impairments, provisions, and intangible assets. Many IAS standards remain in place because they still work, and they work well, and haven't needed a complete rewrite. For example, IAS 1 sets the foundation of how financial statements are presented. IAS 2 governs inventory. IAS 7 covers the statements of cash flows, and IAS 36 explains how companies determine impairment losses. Over time, the IASB updated their older standards and replaced them with the newer IFRS versions. But for now, IAS standards still play a major role in global reporting, especially for core accounting concepts. You can think of them as the classic originals that continue to support the financial reporting structure. Let's talk about the conceptual framework, which is also the foundation. The conceptual framework is the foundation of IFRS. Its goal is to ensure financial information is useful to the investors and lenders. It focuses on the relevance and faithfulness of representation, meaning numbers should actually reflect economic reality. It also defines the building blocks of accounting assets, liabilities, and equity. It also includes the income and expenses. Standard setters use this framework to create new IFRS rules, and companies use it when guidance is unclear. Now, let's talk about one of the biggest IFRS standards out there. It's the IFRS 15. This refers to revenue from contracts with customers. It introduces a universal 5-step model. 1. Identify the contract. 2. Identify performance obligation. 3. Determine the transaction price. 4. Allocate the price. And 5. Recognize revenue when the obligation is fulfilled. This standard fixed many years of inconsistency. Now, whether you're selling sneakers or software, the same revenue logic applies. Let's talk about IFRS 16. This one changed the game for leases. Before, companies could keep many leases off the balance sheet, which made their liabilities look a lot smaller. IFRS 16 requires most leases to be recognized as assets and liabilities. Companies now show a right of use asset and a rental liability. This makes financial statements more accurate and prevents companies from hiding long-term commitments. So let's talk about the IFRS 9. This deals with financial instruments like loans, bonds, and investments. One major change was the expected credit loss model. Instead of waiting until a loan goes bad, companies must estimate future losses upfront. This gives investors a clearer picture of risk. IFRS 9 also modernized the hedge accounting, making it better aligned with risk management practices. So let's talk about IFRS versus U.S. GAAP. IFRS and U.S. GAAP share the same goal, but they think differently. IFRS is principle-based. It relies more on judgment. U.S. GAAP is rules-based, more detailed and stricter. A few major differences. IFRS allows asset reevaluation. GAAP almost never does. IFRS prohibits LIFO inventory, also known as last in, first out. GAAP still allows it. And IFRS is used globally, while GAAP is mostly US only. Despite talks of conversions, the two systems still remain separate. Let's talk about some of the challenges and criticisms. IFRS isn't perfect. Because it is principle-based, it relies heavily on professional judgment, which means two companies might interpret rules differently. Some businesses sometimes struggle with the cost of interpretation and implementation. And even though IFRS aims for global consistency, real-world differences still exist because of cultures, legal systems, and enforcement levels vary. But overall, IFRS continues to improve year over year. So what are the benefits of IFRS? Well, despite challenges, IFRS brings major benefits. Investors can compare companies across countries. Businesses gain transparency and credibility. Global capital markets function more smoothly. And multinational corporations can use one set of standards instead of multiple national rulebooks. IFRS supports trust, and trust supports investments. Let's take a look at real-world examples. For example, when many retail companies adopted the IFRS 16, their balance sheets changed dramatically. Suddenly, billions in leases appeared as liabilities. Ratios like debt to equity shifted overnight. Revenue recognition also changed from software to telecom companies under the IFRS 15. These real-world transformations show how powerful accounting rules truly are. They shape how companies look at the world. Alright, let's go through some boring footnotes. So this is some advice for accounting students and professionals. For students and professionals, IFRS knowledge is a huge career advantage. Standards update frequently, so staying current matters. Focus on understanding the principles, not just memorizing the rules. Practice reading standards and explaining them to others. Whether you become an auditor, an accountant, an analyst, or a manager, IFRS literally can help you work globally and make you better financial decisions. So now let's talk about the conclusion of this presentation. As you can see, I'm now wearing a cape and I'm ready for IFRS. In conclusion, IFRS is a financial language that helps the world communicate. It brings clarity, comparability, transparency to the global businesses. Understanding IFRS is not only prepares you for exams, it prepares you for international careers. Thank you for watching my presentation. I hope you enjoyed the visuals, the explanations, and the journeys through IFRS.